Now, just like we studied the theory of comparative advantage in plain vanilla swaps, the theory is similarly applicable in the case of currency swaps, as we will see in the example below. So let's assume that company A is a big multinational company, and for borrowing in yen, it is able to attract a rate of 5%. However, it is primarily based out of Japan. Hence, the Japanese banks have a stronger relationship with company A and offer very attractive terms. It has a big standing across the world. Hence, even the US banks are willing to lend to company A at a rate of 9.5% if the borrowing is made in dollars. Company B is a US company, however, it doesn't have as strong a balance sheet as company A, and borrowing in yen is costing it 6.5% since it doesn't have a big relationship with Japanese banks, being a US company. And borrowing in US dollar costs this company 10%. Now again, company A has an absolute advantage in both yen and dollar. However, company A has a relative advantage in yen because the difference is 1.5%, whereas in dollar the difference is only 0.5%. So company A has a relative advantage in yen and company B has a relative advantage in dollar. If they both borrow in the currencies that they have a comparative advantage in and then swap, they would be able to reduce their borrowing costs on the whole by the difference of the difference, that is 1.5 minus 0.5, that is 1%. Now let's assume that A needs money in dollars. So this is company A and this is company B. A needs the money in dollars and B needs to expand in Japan. It needs money in yen. Now what we advise A is that instead of borrowing in dollars, you should still borrow in yen. Let's assume the exchange rate is 100 yen per dollar. So if company A needs $100 and company B, for instance, needs 10,000 yen, then what we'll say is that instead of borrowing $100, we know company A needs dollars, but instead of borrowing in dollars, you should focus on the currency that you have a comparative advantage in. So company A borrows 10,000 yen and pays an interest rate of 5% to its bank. What it then does is gives this 10,000 yen to company B. What company B needs is this 10,000 yen. However, from company B's bank, because it has a relative advantage in dollar, company B borrows $100. And on the $100, he pays a rate of interest of 10%. That's the rate of borrowing for B in dollars. This $100 then he swaps with company A. So company A now gets $100 on which he will pay interest to B in dollar terms. Let's assume company A pays 10%. Company B, on the other hand, has borrowed or has received 10,000 yen from company A, which it will have to return, or on which it will have to pay interest in yen terms, to which company B, on which company B pays 6%. So he pays 6% on the 10,000 yen, and in the future he'll give back the yen also. He's taken $100. A pays 10% on the dollars, and in the future he'll return the dollar as well that B can again pay back to his bank. In such a situation, now calculate the cost of borrowing for A and B. So for company A, he has to pay 5% to his bank, and he has to pay 6%, and 6% is what he's getting from B. So he gets an additional 1%, but 10% he has to pay to B. So his net cost of borrowing will be equal to minus 10 plus 6 minus 5, or 9%. Similarly for B, he receives 10, he has to pay 10, and then he has to pay 6% to A. So the net cost of borrowing is 6%. Otherwise, had B borrowed in yen, his cost would have been 6.5. Otherwise, had A borrowed in dollar, his cost would have been 9.5. By entering into the swap, they have both reduced their cost of borrowing by 0.5%. Again, because we kept this number as 6%, we split the benefit equally. Had this been 6.25, then A would have received a 0.75% benefit and B would have received only a 0.25% benefit. At the moment, both of them are getting a 0.5% saving in their cost of borrowing. Once again, from the perspective of the swap, after the borrowing, A has given 10,000 yen and A has received $100. At the maturity of the swap, A will have to return $100 and A will want back 10,000 yen. Please note, now there are exchange rates involved. To repay $100 today takes 10,000 yen. In the future, it may or may not take 10,000 yen. So A has to repay $100 that he has taken from B. Similarly, B has to repay 10,000 yen. How he gets the 10,000 yen is not A's problem. How A gets the $100 to repay to B is not B's problem. So A has to source $100. B has to source 10,000 yen and repay back. So in currency swaps, notionals actually are exchanged initially and then they are taken back at maturity of the swap. Unlike plain vanilla swaps where it won't matter because the currency is the same. So I give $100 and I take $100. Theoretically you can do it, but it won't make any difference. Remember, in currency swaps, notionals actually have to be exchanged. So B gives A $100 and receives 10,000 yen. They pay the agreed upon interest rates. B pays in yen, A pays in dollars. And at maturity, B receives the dollar back or A pays the dollars back, and A receives the yen back or B receives the 10,000 yen back that he had initially taken from A. The slide depicts another way in which the 0.5% can be split as we discussed.
Yes, the exchange rate is doesn't matter only.
Now guys, the method of valuing currency swaps is very similar to valuing plain vanilla interest rate swaps. So you will either be a yen receiver or a yen payer. If you are a yen receiver, you are automatically a dollar payer. So you are long a yen bond and short a dollar bond. Other way around, you would have been long a dollar bond and short a yen bond. Could be fixed or could be floating. But you will be long one currency bond and short another currency bond. If you are a receive foreign currency or a receive yen, then you are long a foreign currency bond and short a dollar bond. All you need to do is to compute the value of the swap. It is the value of the yen bond minus the value of the dollar bond. To compute the value of the yen bond, you will need the yen spot rate curve or interest rates in Japan because you are paying in Japanese yen. To value the dollar bond, you will need the dollar spot rates or the dollar rates to discount because you're paying in dollars. So we will first independently compute the value of the yen bond or the foreign currency bond. Then we will independently compute the value of the dollar bond, and then we will take the difference to calculate the value. But before you take the difference, make sure to either convert dollar into yen or convert yen into dollar. Only then you can take the difference. So you need not always convert yen into dollar. See what the answer is in. See the currency in which the options are given and convert the other currency into that currency. This exchange or this conversion that you will do will be on the current rates, which may be different from the rate when the swap was issued or entered into. So concept is again the same. You value one bond and the other bond, take the difference. Before you take the difference, compute or change one currency so that the two currencies are the same. So let's do an example. Let's assume that we entered into a 5-year swap at which time the exchange rate was 100 yen to the dollar. The interest rates were 9% and 5%. You swapped 10,000 million yen for 100 million dollars. On the dollar, you were paying 9%. On the yen, you were receiving 5%. Now what has happened is that 2 years have passed. 2 years have passed and the current rates of interest. So current rate of interest for 3-year swaps is 8%. And the current rate for 3-year swaps in Japanese yen is 4%. That is, today if you were to enter into the swap, you would have had to pay 8% and you would be receiving 4% in Japanese yen, and even the exchange rate has moved to 95 yen to the dollar. Question asked, after 2 years, what is the value of the swap today? The 5-year swap that you had originally entered, and now there are only 3 years to maturity. This was the original contracted data. This is today's data. Assume that you are the receive dollar party in the swap. So you receive dollar and you pay in yen. Please note that these contract rates 9%, 5%, 8%, 4% are calculated, and it can be proven will come out to be exactly the same as we studied in plain vanilla swaps. So this 8% will be 1 minus Z3 upon Z1 plus Z2 plus Z3. Of course, this Z3 would be 1 upon 1 plus R3 to the power 3. These rates will all be dollar rates or the dollar spot rates. This 4% yen rate that is there would also be calculated as 1 minus Z3 upon Z1 plus Z2 plus Z3, but these Z1, Z2, Z3 would now come from the yen spot rates. Similarly, this contract rate originally of 9% would have been come as 1 minus Z5 upon Z1 plus Z2 plus Z3 plus Z4 plus Z5. All these would have been dollar rates. Similar would have been for the yen 5%, but all these Z1s would have been come from the spot rates at that time. Are the spot rates 2 year back, the 1 year rate, 2 year rate, 5 year rate. Today, it looks like interest rates in both countries have gone down. That is why today's fixed rate comes out to be lower. it's not needed for this question. This is just for your understanding that how are these contract rates derived. They are derived in the same manner as you derived the fixed rate for the plain vanilla interest rate swap. Now once again, like every question on derivatives, we will first depict the cash flows and then discount them back to compute our payoff. Now we were into a receive dollar swap. If we are receiving dollar, that means we are receiving 9% of $100. So on the next 3 years, we'll receive $9 in year 1. In year 2, again, we will receive $9. And in year 3, we will receive $9 and we will also get our $100 back that we must have given in the beginning. If you receive dollar, then we are automatically pay yen. If you are pay yen, then we will have to pay because we have already contracted. This has already been contracted. So we will pay 5% of 10,000 yen or 10,000 million yen. That is 500 yen at the end of year 1, 500 yen at the end of year 2, and 500 yen plus 10,000 is what we will receive, rather is what we will pay, because we must have borrowed 10,000 yen and given $100. So we are receiving the dollars and we are paying the yen. So these are the cash outflows, these are the cash inflows. To compute the value of the swap today, I already have the future cash inflows and cash outflows. All I need to do is discount them back. To discount this cash flow, I will use the current dollar market rate, the current dollar rate for 3-year swaps, or the 3-year par rate. This is the rate that makes the value of the bond equal to the par value, or this is the discount rate today. So this would be discounted back by 8%. Similarly, the yen cash flows will be discounted back by 4%. Had we used 5%, it would have again come out to be 10,000. Had we used 9% here, it would have again come out to be $100. The rates have now changed. This will be discounted back by 4%. So to compute the dollar amount, we would enter N as 3, I by Y as 8, PMT as 9, FV as 100, and compute PV. Similarly, to compute the yen rate, we will enter N as 3, I by Y as 4, PMT as 500, FV as 10,000, and compute PV. This will be the PV in yen, this will be the PV in dollars. So please verify that the dollar value will come out to be 102.57 and the yen cash flows will discount back to a value of 10277.51 yen. This is a positive value to us since we are the received dollar, and this will be a negative value. However, before we can execute the difference, we either need to convert the dollar into yen or we need to convert the yen into dollar. The rate now is 95 yen for $1. So 10277.51 yen will get us 10277.51 upon $95. Or the value of the swap would be 102.57 minus 108.18. That is minus $5.6 million. To the pay dollar receive yen counterparty, the value would have come out to be plus $5.6 million. So in this case, the received dollar has lost and the pay dollar has gained because of the movement in the currency and the movement in the market rates of interest. So if you were the pay dollar, that is you were paying dollars and receiving yen, the value would have been plus 5.61. Which of the following statements is correct when comparing the differences between an interest rate swap and a currency swap? At maturity, there is no exchange of principal between the counterparties in interest rate swaps, and there is an exchange of principal in currency swaps. This is a correct statement. At maturity, there is no exchange of principal in currency swaps. That is wrong. Counterparties in an interest rate swap need to consider fluctuation in exchange rate. That's wrong. In currency swaps, we need to consider fluctuations in exchange rates. Currency swap counterparties are exposed to less credit risk. That's incorrect. In currency risks, you are exposed to more credit risk because of that big notional also that has to be exchanged, which if the other counterparty refuses to give us, can result in a big fluctuation in our value. So statement 1 is the correct statement. The table below shows quoted fixed borrowing rates in two different currencies for two different firms. So company A can borrow in yen at 2% and in pounds at 4%, and 3% and 6% for company B. Which of the following is true? Company A has a comparative advantage borrowing in both yen and pounds. That is incorrect. It doesn't have a comparative advantage. Comparative means relative. It has an absolute advantage in both. Company A has a comparative advantage borrowing in pounds. That is also incorrect. 2 minus 3 is minus 1. 4 minus 6 is minus 2. In fact, this statement is right because he has a much lower borrowing cost in pounds. So company A has a comparative advantage in pounds. Automatically, company B has a comparative advantage in yen. So company A doesn't have it in yen. Company A can arbitrage by borrowing in yen and lending in pounds. Please note, he cannot arbitrage, or the arbitrage opportunity will depend on the forward exchange rates. So please remember the concept of currency forwards and futures, wherein we specifically proved that just because a low or an interest rate differential exists doesn't mean there is an arbitrage opportunity, because forward rates would be such, or pound would depreciate such that this benefit would be vanished. So just an interest rate differential does not indicate an arbitrage opportunity. That also depends on the forward rates. The last question is exactly similar to the question that we just did. Please solve it on your own time and please verify that the answer comes out to be C, minus $9 million. It's exactly the same as the question that we have just solved. So that was about the review on currency swaps. Arguably one of the most important topics. The entire topic on swaps and forward rate agreements is one of the tougher topics in the FRM Part 1 curriculum. So make sure that you solve many questions. A lot of questions fortunately are available on these topics and on these questions. So make sure you solve many questions and you understand the concepts. Solving these questions clears many concepts. It'll clear concepts on currencies. It'll clear concepts on fixed income securities, discounting. It'll teach you about derivatives. It'll teach you about valuing derivatives in the middle of the period. So that's why these questions are important and exciting, because they involve many concepts together. So thanks a lot and see you next time.